Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. A lot of stuff to talk about. Actually, there's always a lot of stuff to talk about. Until the markets stop trading, then there won't be much to talk about anymore. Just kidding. Hey, if you'd like to call, ask a question, participate in today's program, 216-901-0945, 216-901-0945. And that'll get you right into the station. We're going to be talking about several topics on today's show. Some latest technology that's come out. They're constantly upgrading technology, incidentally. So that's not new. It's not new that they are upgrading. It's the upgrades that are new. Keeping up with that is tough. We have a ton of things changing constantly, and I'm sure you know what I'm talking about. And so it's one of the things that we thought we would like to do at Bullington Capital is to try to help people keep on top of things, keep on top of their 401k plans, their retirement plans. We've subscribed to a service that we're making available to our clients. It's going to be a major topic at the next seminar. Because to be financially successful, you've got to do two things. The first thing you have to do is to live beneath your means, because you've got to have to save something and invest it to be able to retire one day. So you've got to be able to live beneath your means, and one of the better ways to do that is to track your spending, which is, I know, is exciting everybody to death. But clients of Bullington Capital have access, are going to have access anyway, to a service that will allow you to set up your accounts, and it will track that for you. How cool is that? Now, you still need to go in and set up the accounts and whatnot, but we will help people do that. We're going to unveil that at the next workshop, which is actually Saturday morning, July 22nd, 2017, just not too far away. July 22nd, 2017. You can go to bullingtoncapital.com online to set up a reservation. There's no cost to attend, although seating is limited. And that's going to be a Saturday morning, 8:30, Corporate College East. Tri-Cities Corporate College, very nice facility there. 8:30 in the morning, there's a continental breakfast, and I'll be talking about this as well as we're going to update things in the markets, some models that we've been working on as a part of the Department of Labor new rules, which they have, looks like they postponed again. These have been very difficult times. They keep telling us that we're going to have to do certain things, and then they're completely unclear about what those things are. But you're going to have to do them. It's oh well. We'll just carry on, and we've got some models where we're going to have to bring out to try to comply. And actually, I think it's a good time to be doing this. I think it's a really good time. Markets are constantly evolving. The markets today don't behave like the markets did 5 years ago or 10 years ago. 10 years ago, there's a significant difference in their behavior. If you look at the late 90s, what worked well in the late 90s doesn't work very well at all right now. You don't know if that'll ever change. I have a feeling that is changed for good. And we are going to go into more detail on that in the second part of today's show. So I'm just going to preview that. But markets don't stay exactly the same. And you have to adjust as you're going along. If you don't adjust, you'll get left behind. And so that's one of the things that we were working on anyway. So the Department of Labor rule comes out and kind of says you have to do it, which I think is actually lucky. The government got lucky. They put out a rule that's actually going to help people. It'll help a lot of people, and I'm really I'm kind of excited about it. I think it's time. There have been so many innovations in the past, even the past 4 or 5 years, and it's it's an exciting time. It's going to be a little bit easier, I think, for younger people, particularly when you have tools available. And young or old, by the way, young as anything out of the grave. When you're in the grave, you're not young anymore. So if you're still alive, you're still kicking. It's all in your mind. It's a state of mind. And I've had clients over the past 30 years. I've had a lot of clients who in their 70s. You would never know that they were in their 70s unless they told you, and stayed that way. Up until they passed away, and that's a beautiful thing. Age it really is. It's in your mind. So these kinds of things will help just about anybody, and they're not that difficult to use. In fact, one of the big resources you'll have as a Bullington Capital client is Bullington Capital. So if you're using these resources that we're unveiling at this workshop Saturday morning, July 22nd, 8:30, no cost to attend. You don't have to be a client to come. You can come and see what we're talking about. But it's a really good idea. This technology helps you track your spending, which I think is one of the keys to learning and figuring out how to live beneath your means, or what you're, just basically what you're spending. So that's a big part of it. Another part is being able to set up and track your accounts, not just accounts that we're managing, but you can track accounts outside accounts, just about anybody. And you're the only one that gets to see that, by the way, unless you ask us to show it to you. Unless you ask us to take a look at it, then you have to set it up to share the views. So, and you can take that right back away. So if you just had a question, that's something that you're going to be able to do as well. And it's a lot more difficult to describe this over the radio than it is in person. I will tell you that for sure. So there are other things, other services that come along with that service. And it's like documents. You've got a trust, you got a will. You want to make sure that those don't get lost. There's a digital vault you'll have access to. And we can, if you don't know how to scan, we do. We can scan it and put it up there for you. Yeah, but you can put anything you want up there, and again, you can control who gets to see it. So it's really neat. Being organized is one of the most difficult things, I think, of the entire financial planning process. It's just getting organized. And then staying organized used to be another challenge. People putting it on their own personal spreadsheets or, keeping their own notebooks. I just think this is a big improvement because it is a lot easier, and you do have help now. So I want to come out and see that. And as always, we'll be talking about developments in the stock market. There are lots of those going on. In fact, if you look at the past 5 years has been very interesting. We'll talk a little bit more about this when we come back from the commercial break. But the past 5 years have been incredibly interesting because there's a phenomenon that used to happen fairly frequently in the United States that now is happening just about everywhere. And that phenomenon, I don't think it's over yet, but it is creating a higher level of risk in certain areas of the market. And if you're smart, you're looking at that and going, maybe I should start to reduce some exposure in those areas, which is essentially what we're doing right now. We're reducing some of the exposure. And unfortunately, by the way, you typically don't recognize that there's a higher level of risk until it's already started to have an impact on you. That's kind of how that works in many cases, not all. So what do you do? What do you do when something doesn't seem to be working? You got to go back to the drawing board, try to figure out whether it's just a normal anomaly. What is a normal anomaly? Well, an anomaly is something that happens that's kind of unexpected, right? And some of those are actually quite normal. For example, momentum strategies tend to do well when the economy is growing very robustly. You look at the 1980s, 1983, 82 through 87. You look at the late 90s, 1995 through 2000. GDP growth was well above average during those time periods for different reasons, by the way. The reasons were entirely different. 1982, nobody knew what the internet was. In 1995, the internet was the rage. 1982, you had really high interest rates that were coming down. That gave a big boost to stocks, but that wasn't the main reason that they were going higher. Profitability was a big reason. Productivity was a huge reason. The gains in productivity were off the charts. So that really worked out well. So in those environments, a momentum style tended to do very well. Now, if those environments don't come back, sticking with momentum, and see, unfortunately, nobody would raise a flag and tell you that was about to work very well. Nobody would raise a flag and tell you that GDP growth was going to be X percent in the next quarter. And if you've watched that at all, you see that it changes quite often. The people that are reporting on it are reporting on what they think has happened, and then they revise it, and then they're making revisions to their projections. So it's an ongoing moving target. And typically, the strategies that work very well tend to anticipate, or at least in the past, they've started working well before the change in the economy, typically by 6 to 9 months. And they would also end 6 to 9 months before the economy started to contract. And so that's changed a little bit. That part of it has changed a little bit. We've gone a long time now with very low GDP growth, extremely long time. And I don't know if it's going to pick back up to those former levels or not. And if it doesn't, then you're probably going to want to minimize those strategies that are designed for that and kind of overweight the strategies that are designed for your everyday types of markets with lower than average GDP growth. And those are more larger stocks, some smaller stocks with certain criteria. But dividend-paying stocks, those have a tendency to do better during those types of environments. And anyway, there's a lot of stuff there we'll be talking about at that workshop coming up here fairly shortly. Again, it's July 22nd. And going forward, we'll probably, I think I'm going to cut down to doing one of these every 3 months. It's actually a lot of work, and we are providing a lot more services through Bullington Capital than we have in the past. So it's getting a little bit more difficult to get out and do these. But we'll do one at least every 3 months. So that's every 90 days. That's pretty good. And they're always free, always will be. Try to be of as much help to smaller investors as possible. It's a big deal. I wish somebody had told me this stuff when I was in my late 20s, early 30s. It'd be great. I was actually learning it on my own. But when you're doing it on your own, it takes an awfully long time. There's an awful lot of reading out there. If I'd had somebody like myself around, it's kind of like having the Cliff Notes. Hey, here's the most important thing. Make sure you get that right. And you get that right, then you can study all that other stuff, the extemporaneous material on your own time, whenever you like to do that. But it's not going to have a huge impact on you. This is what you really need to know. And it's out there. I mean, it's out there. It's buried now. And unfortunately for people coming up today, there's so much more material written than there was when I was coming up. Why is that unfortunate? Well, it's because you might have to read all that if you're trying to look for the same things. It's not a needle in a haystack anymore. It's a needle in one of 10 haystacks. The amount of material is just it's enormous, and I'm just not quite sure how somebody actually gets that done anymore. If you're not being directed to certain areas, to say, okay, these are the most important things. You can still read the other material, but you probably want to read this first. Or you want to do this first. You want to learn this first, and I think that's a really good idea. So we'll be doing that. And incidentally, if you can't make it to the seminar, but you'd still like to talk, you're always welcome to contact us through our website. You're always welcome to call us in the office. That number is 330-664-0700, 330-664-0700. And I'll be glad to speak to you, get back to you as quickly as we can, and just ask whatever questions you'd really like to ask. And I get a lot of them. A lot of them are very good. In fact, a lot of questions I've received from the general public. We've talked about and even done entire shows on the radio program here. And it's really kind of I don't know, it gets sped up the process of my learning in the industry when I was new. Talking to a lot of people, you're getting a lot of questions, being curious anyway. I would look into the answers often just because I wanted to know once that question was brought up. So I don't hear any dumb questions, by the way. There aren't any dumb questions. I guess there is. The dumb question is probably the question that just doesn't get asked because you might be embarrassed or you're afraid to hear what the answer is. I don't know, but go ahead and ask. And the nice thing about the internet is you can do that kind of incognito. You can create a Gmail account if you got a question but you don't know. You can send it in. It's not a problem. So we're kind of an open book, which is what an RIA is. A registered investment advisory firm is an open book. You have to be completely transparent in everything that you do. You have to be completely transparent in everything you do. And I always thought that that's how the business should probably have run from the beginning. And so one of the things I've really tried to do, and it's not so easy to do, incidentally, it's not easy to explain when somebody is looking at a company that's gone way up in price and is now overpriced, that that's probably not always going to stay that way, especially when somebody works at that company or has an emotional attachment to that company. That's a very difficult conversation. And inevitably, there's still stocks, there's still companies. Inevitably, companies go through good times and they go through bad times. It's just the way it works. At some point in time, knock on wood, it's not going to have too big of an impact on someone because they were pretty smart and reduced the amount of ownership in that company down to a reasonable amount. In my opinion, 5 to 10% is a maximum. 10% is absolutely a maximum. That's my opinion. And I know time after time, people have loaded up on their company stock. The stock did so well for 10, 15, 20 years, and then it crashed. Right around the time that they got ready to retire. And I just hate seeing that. I really hate seeing that. And I hate trying to answer the questions of how long, will it take for you to get my money back? And that is that is incredibly difficult because you may never do it. You may not live long enough if you wait too long. And so let's see how we can plan to avoid that scenario when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. I'll be right back.
The best things in life are free.
And we're back. If you'd like to call us, 216-901-0945. 216-901-0945. And feel free to send me an email if you'd like to, bill@bullingtoncapital.com if you have any questions. We're just talking about quite a few topics here this morning. One of them is getting your financial life organized. We've got some tools that we're going to be displaying at the next upcoming workshop, Saturday, July 22nd. You don't have to go to a seminar, by the way. If you want to call us and just set an appointment, you can do that too. One of my assistants or myself will call you back and basically show you what I'm talking about. And it's very interesting. Investing is tough. Under the best of circumstances, it can be very difficult. So it's a little like marriage that way. And guess I shouldn't. No, that everybody knows that. So I guess that's not too bad. You have to be really careful today. Say something and someone gets offended. It's it's just the way it is anymore. But believe me, anything you hear on this radio program is taken with a grain of salt, or you should take it with a grain of salt. Don't take it too seriously. If you're going to be a good, solid investor, you're going to be able to relax in your portfolios. Which, by the way, is kind of a big deal. You don't have to worry about it. When you're doing the right things, you don't have to worry about it. In the long run, it will take care of itself. In the short run, if you don't know much about it, it's going to upset you. If you don't know much about it, you'll get really upset. And those are some of the things we'd really like to help people out with, And one of the things I at some point in time, I think I'll probably start doing is going around to junior high schools. Because when you're 12, you've already learned percentages in school. When you're 12, you already have learned percentages. And percentages are one of the most important concepts to all of finance. It's used in almost every aspect. Now, they like to call it a lot of different things. A discount rate, that's referring to percentages, by the way. So that's probably one of the more difficult ones for people to comprehend. And it's really not, it's because of the way it's being explained. It's not a difficult concept. So when you're 12, you've already learned enough about basic math to be able to manage an investment portfolio, believe it or not. You can do it. And what you're probably going to come to the conclusion of is that you're probably better off looking at various professionally managed funds out there, which is kind of the conclusion that everybody arrives at sooner or later. Unless you just do it for a living. I mean, if you become one of those professionals, then great. And maybe 12-year-olds hear this kind of thing and they get motivated and want to take finance classes and start investing, start opening up IRA accounts. You got a paper route, you can have an IRA. You can start doing that when you're 12 years old. And I think it's a great time because their minds are like little sponges. They grab that stuff up and they'll run with it. And it's the same stuff, by the way, that's not being taught in high school. It's really not even being taught in you can get a financial planning degree, a 4-year financial planning degree, and you won't learn a lot of this stuff. Most of it you're going to learn on your own in the field. And if I can speed that process up, boy, that would be a big accomplishment. I'd be happy if that's what it said on my tombstone. Bill Bullington cut the learning curve for finance, personal finance for X number of people. I don't know. Anyway, so when you're 12 years old, you've got enough math behind you to be able to do whatever you need to do in finance, personal finance. And think about this for a second, by the way. Warren Buffett, when he was 12 years old, had a paper route. Warren Buffett understood the leverage. He understood percentages. Exponential growth, which is another thing. It's related to percentages. It's directly related to percentages. So he went and hired some other kids to deliver the papers. And I'm assuming that he did all the collecting and the billing himself and then split. Because that's one of the things a lot of kids with paper routes didn't like to do, go door to door and have to collect the money. And so this guy was getting an override on all of his buddies when he was 12 years old. Talk about an advanced student of business. That's hilarious. Now, I don't know if any of that's true, by the way. I just read that somewhere. So I can't verify it because I didn't, I wasn't there. But that's what I read. So I'm thinking that's pretty funny. I also read that, one of the things that he did with the money, him and a buddy, they went and bought some pinball machines, had them refurbished because I guess they were older. And then they went and put them in for free into some local barber shops, and they would maintain them just to be able to split the profits that the pinball machines made with the barbershop owner. So when you're in there waiting to get a haircut, you could play some pinball on one of Warren Buffett's pinball machines. And I thought that was hilarious. That's a great idea. And now you see how business owners think. Incidentally, if you want to get really, really, really rich, it's owning your own business. By the way, investing is okay, and if you do it well, it should keep you ahead of inflation, and that's not, that is not a minor thing. But if you do it really well, it should keep you ahead of inflation and taxes. Hopefully, the better you are, the bigger the gap between your returns and taxes and inflation. So, but if you really want to get super rich, you want to buy businesses completely. And when you're buying the businesses, that excess cash that you get, then you invest in stocks. That's exactly what Warren Buffett does. He's a business owner. He owns multiple businesses at this point in time. But I think there's a broad misconception over how some people accumulate their wealth. The vast majority of people do not do it by investing in stocks. They take ownership in businesses, which is kind of what you're doing when you're investing in stocks, but you're not taking nearly as much risk if you're doing it with funds or baskets of stocks. And I don't think it's a really good idea for anybody to concentrate their portfolio into one or two stocks anyway, because when you're wrong, it has very large impacts on the rest of your life. So if you're not going to be in that business, you still need to know some of the things that people are doing that do that. Portfolio managers. You just need to know what the basic descriptions are, how they're doing it. Let me give you an example. So there's a fund that invests just in large company stocks, large company defined by top 10% in size. Just top 10% in size. So if you took all the stocks in the U.S. stock market and broke them up into various sizes, actually this would be the top 20%, I'm sorry. So if I take the 20% right off the top of the biggest, and I break them down into each sector that makes up the stock market, and then I go a step further, and I buy the stocks within those categories that have the highest yields, dividend yields. What percent yield do they have? Yeah, that's a strategy. That's out there. That's what somebody's doing. So pretty easy when you think of it in those terms. When you read the prospectus, it can be a little confusing because they use a lot of other terminology to describe the things that I just described. But that's basically the basis. And then when you see something like that, then you want to take a look at its track record, see how it's done, try to get familiar with valuing a company. That's not very hard to do, incidentally. We're going to do that at the workshop, too. It's actually relatively simple. The problem is the values keep changing. Why do the values keep changing? Well, because sales keep changing, profitability keeps changing, and so what you're really doing when you're looking at individual companies or what the portfolio managers are doing are saying, hey, okay, we're going to diversify. We're going to spread this out because there is a lot of risk by putting all of your money in one company because sales will change, because profitability will change. And over time, if it changes and it happens to turn negative and you have all of your money in this one company or even a handful of companies, that could be very bad, have very large impacts on your financial life. So if we say we're going to take a basket of securities to spread that risk out, that's what people like to refer to as diversification or asset allocation. Anything that's got more than 3 syllables in it, by the way, PhDs love to use. They love to use those words. Yeah, and that's okay. It's basically spreading out your risk by investing in more than one company. How many is too many? I don't know. I really don't know anymore. It's pretty interesting, the developments that have gone on over the past 20 years, really. And they continue to develop. In fact, some of the developments over the past 5 or 6 years, I think have been exceptional. And the problem is that they've been drowned out by noise from maybe some non-exceptional things that sounded better. And that's a trick. Okay. But as I'm talking about all these things, I'm realizing I'm probably talking in circles and just confusing an awful lot of people. But the bottom line of what I'm really trying to say is start young if you can. Encourage your grandkids, by the way, to start to do this. It doesn't have to be complicated. It is a complicated world out there. There are thousands of investment choices to make. You need to get familiar with just the basics. 12-year-old that can actually do it. If I were to say to you the earnings yield on a company, earnings yield is very similar to a CD yield, except for in the case of an earnings yield, we're taking the earnings per share, the profits per share, and we're going to divide by the share price. In fact, I'll give you one right now. I'm taking Procter & Gamble. I took the earnings, let's see, latest quarter. Sorry. Apologize for, it's $15 billion. And the earnings per share, if you divided the 15 billion by the number of shares outstanding, $5.46. So that's what Procter & Gamble made in the past 12 months, $5.46. So if you owned 10 shares of Procter & Gamble or 100 shares of Procter & Gamble, and they decided to pay it all out as a dividend, 100% as a dividend, you get $5.46 a share. Is that good? I don't know. Depends on how much you paid for the stock. So today the stock is selling for $87.15, which I think is pretty good. Because if you divide $5.46, the earnings per share, by the $87.15, you get a yield of 6.2%. That's actually very good. In fact, I think I just talked myself into my next purchase. I'm going to take a phone call right now. You can call us 216-901-0945, 216-901-0945. And I got Joe. Joe, you got a question for me?
Yeah, hi, Bill.
Hey.
I wanted to ask you about stock buybacks and how the flurry of stock buybacks that have been occurring over the past 5 to 10 years have kind of skewed the earnings and the stock prices, and whether this rash of buybacks is going to be coming to an end soon.
Yeah, actually, that's very interesting because the rash has been slowing down now past 15 months or so. They haven't been buying back nearly as many shares in the past 12 to 15 months as they had the prior 5 years. So very good observation on your part. They have been using cash to buy back their own shares. What that does is it increases the earnings per share because now you're splitting up the earnings amongst fewer shareholders. And it's financial engineering, which is not necessarily a bad thing because once they buy those shares back, they can't just turn around back and sell them again unless they get the board's approval. So they're not going to be splitting up future profits amongst those shareholders again. So it's okay. But you'd rather, most board directors on the board would rather see them investing in businesses and growing their business organically rather than buying back shares to push up the earnings per share. So I don't think once you do it, by the way, it doesn't have an impact going forward. The sales and profits will. If the sales and profits don't continue to grow, the earnings per share are not going to grow because you've stopped buying back shares now. So could it have a big potential? It could. I don't think it would be huge. And what I've been seeing personally, I get a little thing. They call it the Orange Book. It's an interview with top 500, like Fortune 500 CEOs. Many of them have been talking about this, and they've been talking about now they're investing in new businesses because they see new opportunity. And to me, that's a good thing. It's a good thing that's happening. A lot of those won't work out. A lot of them they'll go into new opportunities and they don't make as much as they thought they did, or some problem will pop up. But then again, some of them are actually going to work out much better than they had anticipated, and that's kind of how the whole stock market has always worked. So I don't think there's anything to be alarmed about right now. I think you just keep your eye on it. Keep your eye on the things that companies are doing. That's one of the reasons I like to have methodology set up for my portfolios that I'm managing. I've got X amount of money in stocks that are looking for companies that are having a certain growth rate, that are not above a certain valuation level, and this kind of rules-based investing. And many times I'm not using, they're not my rules. Today we're going out and looking, products have been created. If you can think it or dream it, I promise you somebody's created a product out there that matches what you're looking for. Finding it's a little difficult because there are thousands of them. But anyway, did that answer your question?
Yeah, it did, Bill. Thanks very much.
Well, hey, thanks for calling. Have a good weekend and happy July 4th.
You too. Bye-bye.
Bye-bye. And we'll be back after these commercial messages. And we're back. Hey, I'm going to go right to the phones. If you'd like to call 216-901-0945. And I've got Jerry on the line. Jerry, how you doing?
Good morning, William. First, I just got on a few minutes ago, but I got when you were talking about the stock that you almost talked yourself into, what were you referring to?
It's Procter & Gamble.
Procter & Gamble, okay.
Yeah. They've made quite a few moves there over the past couple of years. It's not a stock that I would say is significantly undervalued, but it's fairly valued, and I love their products. I mean, everybody uses Procter & Gamble. Go to their website. You probably have a half a dozen of their items in your home right now.
I'm familiar with. I like them. I tend to prefer Colgate myself, but that's just a matter of preference.
It's got a 3% dividend yield as well. It's only a little over 3 times revenues, which is really not bad. And for that type of a company, that's super high quality.
They're both very good companies, no doubt.
Yeah, and very reasonable price. That's what I like about it. It's a reasonable price. Last time I looked at Colgate, let's see. I haven't looked at that one in a long time.
They've gotten trimmed a bit. I've been seen them as high as 72, 73, and they've been as low as about 64, 5.
Well, here's how I tend to look at these things. Right now, the market is valuing Colgate at $65 billion, and they have $15 billion in revenue. So it's selling at roughly 4 times its annual trends. That's a 25% premium to Procter & Gamble. I guess I ask myself, is that really worth a 25% premium?
Probably not.
And the dividend yield is a third less than the dividend yield on Procter & Gamble. So I don't know. And I watch now, because I said this, Colgate will actually take off tomorrow, and Procter & Gamble will go down.
No, I understand. I see that all the time. All righty. Couple of questions here. The Verizon, is that hitting the radar as far as the possible dividend model? It's
been in and out depending on that sector. Because if another stock comes up and the dividend yield actually surpasses that one, then it automatically switches. But that doesn't happen all that often. And I have seen it in multiple times over the years. I have to go back and check because I only have a few thousand stocks on my my models.
I just read something. I think it was in Barron's recently, as far as the telecoms. They're all getting hammered. That it may be time to look at them just from the possibility of a contrarian standpoint. That possibility of a stock buyback. I know you spoke about that a few minutes ago, as well as consolidation in the industry. They're all relatively cheap now. They seem to hopefully have secure dividends, and I don't know.
Yeah, well, everything you said, I would concur with. And I'm just looking at their revenues, their market cap. Revenues are down a little bit, not a lot. The dividend yields are high. So actually, I am quite sure that this one's in the model now that you said that. So I just double checked. Its current yield being a little over 5%. Here's where this gets really interesting. So I have AT&T in my office for fiber optic because we have a really, really, really fast internet connection. And I was talking to the rep there, and Verizon's trying to merge with Time Warner, and all these guys. And the reason being that he said anyway, and I don't know if it's true or not, I have no way of verifying this, but was that Google had purchased an enormous amount of FM frequencies across the country. I don't know if you remember a few years ago, the FCC passed this rule that broke up radio frequencies into, it multiplied the available number by something on an order of 50 because the digital technology was different than the technology they were using before. It was an analog technology. They were able to create many, many, many more frequencies than had currently existed. So Google went around and purchased a bunch of these up around the country and continues to do this. And at some point in time, plans on offering not only the content that they're producing. Google has a thing just like Amazon Prime and just like Netflix where they're producing their own content. They also have YouTube, and they're looking at providing like the cable service with the internet and your phone service all wrapped together in a bundle. When your phone, by the way, and Apple, I think was the first one I'd ever heard talk about this, and this was years ago. But Apple talked about doing this, and Google looks like they're trying to work towards this, where you bring your phone with you, Your phone connects to multiple networks, and FM, by the way, is like cellular on steroids. So if you can provide the internet over FM frequencies using newer technologies, the speeds are going to be pretty phenomenal. So you'll be able to download whatever you want to watch. You'll be able to interact with people in like through a FaceTime, like a video sharing thing at the same time. You'll be running all these things off of your phone. When you get to your house, you're going to plug your phone in. It's going to detect that you're in there. It's going to switch over to the receiver that's in the house that powers your television and your computer and your phone. And so Time Warner, that's one of the reasons that Time Warner and AT&T were trying to merge. At least that's what the guy from AT&T was saying. They're looking at what Google's doing and going, uh-oh. This could be big.
How about IP? That's been mentioned a bit too. That's got a solid dividend. It's moved up a little, but does that have any interest to you? Or?
Yeah, right now the price to sales ratio is only 1, which is very moderate. Dividend yield's 3.27. That's not bad. I wouldn't look for big time growth.
No, of course not.
Yeah. But
that's not a growth stock at all, but it's a solid blue chip. I mean, get into that, buy some or sell some calls, perhaps puts against it, and play. You can probably generate 10% on it fairly easily over a year.
You could, but you have to keep in mind, when in the year, I'm looking at the long-term chart on it. It was $55 in 1997. Okay. On January 30th of 2009, it was down to $9.
Whoa.
So the cyclical companies like that, the really big cyclical companies, they still move. People don't realize they still move like other. Yep.
Yeah, I'm surprised to hear that.
And by the way, that was lower than it had traded for during the 1980s.
Jeez, oh man! Yeah, and I had no idea it was anywhere close to $9 a share. Yeah. That is interesting. Yeah, well, like you say, it's a stock. It can go, up or down. But boy, that's a phenomenal drop.
Oh, I know. It's tough. Look at Ford. I mean, it's it's just they're stocks. That's why you got to have a plan.
Yeah, absolutely. You got to watch them like a hawk if you're doing as I suggested.
Yeah, if you're doing, you have to really watch that. I mean, super closely. And I'm not sure that actually watching it's going to help you. It's going to fatigue you, and because the stock's still going to move wherever it's going to move.
Well, I'm involved in the industry that it's primarily involved. I'm in the printing trade, and it's printing papers are not a major part of its business. Well, I mean, they're 15 to 20% anymore. I mean, at one point they were probably as high as 40%. It's more cardboard and box board, that type of thing, packaging today. Right. So it's perhaps not as cyclical as it once was.
Hopefully not. Hopefully
based on what you've said, surely. But it's more a diversified forest company rather than strictly a paper company, although the moniker suggests differently. One last thing, Bill. How about some momentum stocks as of this past week? You want to throw anything out there?
There have been a lot that have been coming up within the solar space.
Mm-hmm.
I mean, there have been dozens of them. I should not dozens. There are about a dozen, which is a lot because there aren't many solar stocks to begin with. So when I see that, and I see that, every other day another stock that's a solar stock is coming up on the scan, I'm like, okay, there's probably something going on there that we are not aware of yet. Eventually, and if this works like they classically work, I have to give that caveat. Sometimes they don't do the classic thing. But classically, the stocks will run up a long way, and then the news comes out.
Yeah.
And so I would be paying attention to that if
Maybe
you start to see.
That. Okay.
Yeah. And there are a couple of them that are out there. In fact, on the website, the Look Out for the Bull website, I do post when I see something I think is interesting. That means it's got a relatively reasonable valuation. A decent story, and it's got good price movement. Now, that's as good as you get. Okay, so And by the way, I tend to lose on more transactions than I win on in those portfolios. It's just that over time, the winners have been bigger than the losers.
Well, I was going to say one other thing I have noticed that you have said countless times before. Every time I follow this AAOI, Applied Optronics, I can't even pronounce the name of the company, that you think that it's no longer in a momentum mode. It goes the same way. That darn thing, it goes down to 58, and then bounces back at 62. So it's like a rubber ball.
Well, actually, it's only been in that range for a couple months. It seems like that when you're following it. It seems like it could be, like that's forever. But when you look at the grand scheme of things, it's it's really not. And so you're probably
is a momentum stock. I mean, is there any duration? It's a momentum stock until it is, but generally there tend to be within 3 or 4 months. I mean, very rarely see a momentum stock that goes into 3 or 4 years, do you?
No, you never see that.
Okay.
In fact, you used to see 12 to 18 months. Now it's much shorter. So anyway, I got to take I'm gonna have to run here. The show's almost over.
Very good.
Hey, thanks for calling.
Bill. Have a great holiday.
You too. Bye. Thanks for listening, everybody. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good luck, good investing, and have a happy July 4th.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or...
This weekend, every drop of paint at the Home Depot has even better coverage. Thanks to red, white, and blue savings of $10 off 1-gallon cans and $40 off 5-gallon buckets. That means more paint for less money, so you can cover more walls, more rooms, and more of your budget than ever before. So, how's that for great coverage? Unbelievable quality, unbeatable prices. Red, white, and blue savings now at the Home Depot. More saving, more doing. U.S. only, valid through July 5th.
Not your lifestyle.
How much money do you want to make in the next year? Think you'll fall short? Think again. If you've ever thought about making money flipping houses, this is the moment you've been waiting for. Hi, I'm Preston Neely. If you want to set your own salary, I want to send you a free copy of my smash hit selling book, How to Get Rich in Real Estate. Grab your phone and call 1-800-700-4883. Real estate made the president a